From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 18th, 2020, and you're listening to the HPS Macrocast. I'm Matt McDonald in for Tony Fratto this week, and I'm joined, as always, by John Fagan and Brendan Walsh from Markets Policy Partners. We have the pleasure today of also being joined by one of Tony and my other distinguished partners, Stacy Kerr, who's going to weigh in on some of the campaign and election and post-election prognosis. We are less than 50 days from the election right now, so we're going to touch on a few of those points as we go through. But we wanted to start with the Federal Reserve and their statements over the course of the week and weighing in on things. So John, what is their impact on the economy this week? How are they framing up things as we think about the remainder of the fall here?
Thanks, Matt. Yeah, the Federal Reserve had a two-day meeting today, which concluded on Wednesday. And it was definitely a meeting where we had probably more than usual uncertainty going into it. This is even after Fed Chair Powell announced a pretty meaningful shift in policy at the virtual Jackson Hole conference in late last month, where he unveiled the concept of average inflation targeting, which is a more permissive stance toward the inflation target that the Fed had always held of 2%, and they use core PCE typically for that metric. And this was to basically make it official that the Fed was going to be far less proactive in trying to hit that and being more comfortable going over it for an extended period of time. They obviously hedged themselves and saying, untoward or unwanted inflation will be met with policy responses. But they also married this with a refocus on the full employment target and really basically saying that the full employment would be focused with a sense of how lower income echelons are being, within the employment metrics. So it was a pretty dovish formulation. And so the analyst community was a little bit split going into this meeting, basically thinking, how will they then reorient their policies in order to hit these now more ambitious inflation and unemployment mandates, and the Fed announced what amounts to a really historical dovish formulation of their policy. It was supposed to be that the moniker was enhanced guidance. Was this really going to be enhanced guidance, which, at least in its strongest format, is directly tying policy choices of rates and asset purchases to outcomes on the inflation and employment fronts. The Fed fell short of the most extreme version of this and basically said, but although it was still very dovish, the projections are for zero interest rates are going out through 2023. That's new. The Fed has basically created this formulation in which they anticipate that they will not be raising rates until they've achieved full employment goals and inflation is not only at the target, but is likely to be heading above the target. And this is and quantitative easing, they actually kind of put to the side as, we're going to be continuing that for the coming months. So the real focus here was on the rates. The market reaction was a little nuanced. I mean, you could be forgiven if you just looked at the market reaction, you'd be forgiven for thinking maybe there was a hawkish surprise in there somewhere. And this is not the kind of environment where you get a hawkish surprise. What it looked like to us is that the Fed didn't choose to be as wildly dovish as they could possibly have been in the conception of some analysts, and so that resulted in a relatively muted market reaction. Stocks sold off and have been sold off for a couple of days after the Fed meeting. The dollar kind of got a little bit of support and then headed back. The Treasury yield curve flattened out a little bit. Market-based gauges of inflation expectations didn't go anywhere. We're talking about break-evens and five-year inflation swaps. Those didn't go anywhere at all. And so, the markets have kind of yawned at this when it's you can argue that it's a really meaningful policy. Minneapolis Fed President Kashkari is out this morning with an article kind of trashing it. He was one of the dissenters. There were two dissenters, one on the hawkish side. That was Kaplan from Dallas. And he basically said, look, this leaves optionality for the Fed to make the same mistakes it's made in the past, which is proactive tightening ahead of achieving their mandates.
Yeah, and Kashkari makes two really good points where core PC inflation, for the last 30 years, runs between 1.5 and 2%. It very rarely gets over 2%. So they really never meet that mandate. But then more importantly, they don't really know how to judge what maximum employment is. They were wrong this whole recovery. They thought it was, 4, and every month we went down lower and lower. So he's just saying, he's not necessarily against like being cautious and trying to
pro humility,
economy, but that they're probably not doing enough because their estimates of where the economy is has been wrong for the last 10 years.
I want to like talk about this a little bit because it struck me that there was more, at least it felt like there was more dissension in this announcement than I've detected out of the Fed in a while. And it's interesting. And coupled with that, it felt, I read some, I don't know, criticism or observations that there's like, I don't know if you call it less transparency or just it more unclear of exactly the direction or exactly the metrics or that sort of thing. It feels like the Fed is moving in a direction of like a little more uncertainty, that the markets are going to have to do a little bit more interpretation going forward than maybe it felt like certainly at the beginning of the pandemic when it was clear, it was clear the direction and there was kind of a unified frame on this stuff. Is that your sense of things? Is there going to be like more just kind of divergence of views within the Fed and in perception of the Fed going forward?
Yeah, the two dissents were we've seen a really united front from the FOMC, and partially that's because of the high volatility of the last few months and the terrible backdrop. The Fed presenting a united front is important for optics and communication credibility in these tough times. Now that we're getting into a little bit more of an equilibrium in terms of the recovery and in terms of COVID, hopefully, knock on wood, then this has allowed a little bit of this dissension to bubble up. And I think the uncertainty really is centered around the fact that if the Fed has made these targets so ambitious, but it has not yet really, proportionately upped its efforts to hit those targets, then what does that mean? Does that mean that they're scared to go further? Does that mean what's going to trigger more easing? The idea is basically if they start backsliding, then they're going to do more QE.
Right.
And that's basically the formulation. But
and when you look at the
when and
right, but when you look at the dot plots, everybody is in agreement that they're not going to raise rates for the next 2 to 3 years. There's no dissension on that. It's everything else within their toolkit. When do we use it and how aggressive are we to try to reach these aggressive mandates that we've done? So on that front, and especially when it comes to the equity market, because the equity market loves QE. You certainly will see a decent amount of, volatility from time to time. If the market gets on a little stress and the Fed doesn't up their QE, you're going to have the moments of anxiety that we've had over the last, about 8 years since we've been doing QE.
Yeah, but there's also the uncertainty about, hey, what if we get a really effective vaccine? The economy starts really rocking. We've got a stimulus package that comes through. We're getting back to normal. Things are good. The Fed is not we're still pretty far away from these targets because it takes a really long time to hit them. But financial conditions are outrageously loose and the economy is roaring back. That's what Kashkari is really referring to. Can the Fed really hang on to this pretty squishy commitment? It's not a commitment. They're not lashed to the mast like Ulysses.
But John, you also make a really important point that we're not in normal economic times. So, a vaccine could come. That has nothing to do with economics. That has to do with bioscience. But more importantly, there's a bill right now to spend $1.5 trillion. When back in 2009, we spent $900 billion and everyone thought it was the biggest, most intense recovery package we've ever done. We've already spent $3 trillion. Now we're arguing over $1.5 trillion. we kind of think it's going to happen, but that's a huge amount of money that will have an effect on the economy, and that the Fed has to take into account, or it might not happen.
So let's talk about the stimulus and the bill, and I want to bring Stacy in on this as a little bit of a. I mean, I want to figure out some, or at least talk through some of the alignment between the markets and DC. Stacy, what's your prediction forecast on whether they get to an agreement on another stimulus package?
Well, two dates coming up to watch, right? Let us not forget the a possible government shutdown coming at the end of this month, September 30th. Unlikely to see how that really happens 40 days before an election, but there is still congressional action required. So we'll be watching to see if they can pass a clean bill and punt that until after the election. And then, both chambers are set to leave for recess in early October. Speaker Pelosi has said she wants to stay until a bill is done. Unclear if that is, a negotiating tactic and posturing. We saw the president come out this week and a little bit blow up what has been some of the Republican sort of posture on a bill, and come out and say they want a bill. So a lot of a lot of pushing back on the Senate to get something done. Look, I think in a weird way this week, maybe they got a little closer with this $1.5 trillion bill out there. A lot of the attention has been over state money to the states. I think we saw Democrats originally in their HEROES Act. I think they were at $900 billion over 2 years. I think Republicans were at something very like $100 million of repurposed money. Now we come out, you can see a scenario where Democrats would say, great, we'll do 1 year, we'll take half of that. We're going to hedge on a Biden administration coming in and getting more money that we wanted out of a Biden administration in their recovery packages. Republicans come up a bit, and now you're getting a little bit closer, 300 billion, 100, we're not so far away anymore. So I actually think the steps that we took this week look like they certainly bring a bit more of a possibility for a negotiation and a bill to happen in the next couple of weeks than we were, say, at the last week. So a lot of negotiating still to be done.
John and Brenda, do you guys think that that aligns with market perception of a potential follow-on stimulus?
I think so. I think the market is anticipating a stimulus bill of some kind. I think that there's been some cautious price action over the last couple of weeks, some real chop in equities, obviously. But the chop has been more about kind of a correction of the high flying tech stocks, which aren't really tethered to the growth outlook to a great extent, not the way that financials and industrials and material stocks are. So I think the market is poised in expectation, anticipation that something gets done. And I think that there would be disappointment evident in financial markets if not. But that there's still a lot of detail left to be put together. My question for the experts, Matt and Stacy, if the House Democrats and the Republicans, and the White House are pushing for a bill, if they agree on a bill, do you think that the White House is going to have enough juice with the Senate Republicans to pull enough of them along? Or would this? What are the odds that the Senate Republicans step in and are the final, the final blockage that prevents this bill from going through?
I think that sort of speaks to how a bill like this would be negotiated. Are we going to see the Speaker and Mnuchin, who seem to have had probably the best relationship in all of this, and Mark Meadows negotiate around Senate Republicans and then try to force their hand? The other piece that, I think is important to look in this is just the raw politics of this. And from the Speaker's perspective and the raw, on the politics, she is looking to increase her majority, certainly hold the House, but increase her majority. And she's put her Democrats in a position, her caucus in a position where the more progressive Democrats are able to go campaign on the House passed HEROES bill that was sort of loaded up with a lot of what progressives want. And now she's got the problem solvers who have a bill out. And so they're able to go back and talk about what they are for. She's put her members in a pretty good position to, to be able to campaign without actually having passed a bill. And so anyway, I think you can't look at this without looking at the raw politics of it. It's hard for me to see how the White House and the Speaker completely negotiate out a bill and then force it down the Senate. But I don't ever bet against Nancy Pelosi's negotiating abilities and ideas.
Yeah, I think I think that the politics of it are going to weigh in on this, and I think that McConnell definitely has an eye on the Senate majority and what he needs to do for his members in competitive races coming down the stretch. So
absolutely,
I think that there is to the extent that an additional package helps them make the case for what they're doing to help, shepherd the country through this moment, I think that there's a case to be made there. Let's take a break. And when we come back, we'll turn to, we walked right up to the doorstep of the election. So let's just talk about it when we get back.
Our Associates and Analyst application is open. We are looking for current college seniors interested in economics, political science, or public policy to join us for a 2-year leadership program with start dates in June, September, and November 2021. Apply today and work on the top debates and policy issues in tech, healthcare, energy, trade, and more. You can apply by visiting the careers page of our website at hamiltonplacestrategies.com/careers. The application is closing soon, this Sunday, September 20th at 11 p.m. Eastern.
All right, we're back with the HPS Macrocast. This is Matt McDonald from Hamilton Place Strategies. I'm joined by my partner, Stacy Kerr, and John Fagan and Brennan Walsh of Markets Policy Partners. Let's talk a little bit about the election, and there's a couple things that I want to drill down on that are interesting, that I think are getting the attention of politicos in DC. I don't know whether they're getting the attention of the markets yet, but I think some of these pieces are almost sure to bleed over. First is election uncertainty. I've been surprised at the number of conversations that I've been having with, Republican operatives or politicos in the past couple of weeks who have grown increasingly bullish on Trump. And you see in some of the media prognostication, there's been some hedging that I think has been interesting to watch. I think everybody thought that the election was going to be close. I would say I'm not exactly in that camp, but I think that the potential of uncertainty for a variety of reasons around the election, the outcome, when we know the results, just the mechanics of mail-in ballots or when things are going to get reported. I hope that the media is going to be cautious on calling races and figuring some of this stuff out. I don't think anybody was kind of covered in glory the last time around on this. So I think that they need to be careful on that, how the different campaigns and the different parties are going to react to the outcome, and how after an outcome is known, what that looks like after the fact in terms of close races or contested or recounts or change in leads or any of that stuff. I think that the political world is starting to focus on the possibility of post-election uncertainty. One, Stacy, I'm curious for kind of your view on what you're hearing on that dimension and how people are thinking about it. And then John and Brendan, I don't get the sense that the markets are really calibrated to the amount of political uncertainty that I'm hearing around Washington. And I don't know what they do to calibrate that, but I think it's an interesting question to think around the corner a little bit on. So Stacy, what's your sense on this?
Yeah, two sort of really interesting points I think that have come up on this. I'm sort of with you, Matt, where I still see a scenario where this may be a 40-state election. I mean, one scenario is that we actually do know who won on election night. We have to prepare certainly for the possibility that we don't, but I don't think we're out of the woods yet of a 40-state election in which we do know the winner on election night. I do think what makes this race interesting is this very small number. Y'all have heard me say this before, a very, very small number of undecided voters. I think voters have made up their mind, and this will be a turnout election. It is certainly, as we've talked about, Matt, a referendum election, and we can come in a bit more on that. But I think the other thing that I'm hearing sort of and seeing from Democrats that maybe we haven't always seen in the past is, the Biden campaign came out and talked about the legal apparatus that they've put in place for the uncertainty and how that's being funded and how that's being orchestrated. We certainly never saw that in 2000 until after the fact. And one of the big thing, I mean, money in politics still matters. And the Biden campaign has been able to neutralize the Republicans' money advantage, and they're able to put a lot of resources into these post-election scenarios, for lawyers and their legal apparatus. I mean, I think they have built the biggest legal team for a post-election, which is smart, but not always possible. And I think they now have the financial resources and the organizing capacity to do it. And we're seeing that they're doing it. So that's a big piece that Democrats have been talking about, the preparation for it. I don't think we've necessarily, I have to believe that Republicans are equally prepared. I think a lot of the noise of Washington talks about, the Trump posturing and what that's going to do for this and what Trump himself is going to do on election night, or what his sort of stance will be as it relates to others. There are many scenarios where Congress comes back into play on this. And what we've seen from Congress is a willingness of Republican members to follow this president. It will be very interesting to see how that happens as Congress comes into some of these scenarios, if they are brought into post-election uncertainty. So I think I guess the bottom line is much more preparation on the Democratic side, and probably the highest level of uncertainty that we've ever seen and going into the election.
And from the market's perspective, when our clients, our financial industry clients ask us about the election, it really tends to be very much about this question of process, the validity, the perceived validity, the length of time that it'll take, the acceptance of the result, not just by the candidates themselves, but by their supporters, and these bedrock cracks in the foundation of our democracy are things that are troubling to investors, based on the volume of questions that we get on them, and certainly the amount of ink spilled among investment strategists. Certainly you can see it. It's a little bit hard to see in current markets. That's not a big surprise. Markets like the equity market tend to not price in election outcomes until much closer to the polling day. And it usually sort of builds an intensity going into it. The distrust of polls and the sense that it's not capturing, particularly Trump voters, shy Trump voter phenomenon and so forth, is something that's very much in the conception of a lot of our clients on Wall Street. And so it's tough to position for it, but you can see when you look at the equity volatility futures, those are elevated, not just going into October and November, but they stay elevated for months thereafter. And that's indicative of expectations for what you're saying, which is a protracted, dragged out, and very uncertain and untried process. We just, the 2000 episode was disruptive enough and weighed on markets. But everybody's conception is that, anything disputed will make 2000 look like, a racquetball game, compared to what we're going to undergo this time potentially.
John, the other piece of this that is not getting a lot of attention, but could also bring more uncertainty, is the uncertainty of Senate outcomes. And the Democrats need to pick up 4 seats to retain or to take over control of the Senate. There are, one big state in particular, North Carolina, that has both a very close presidential ballot going and a big Senate race going, and a big close Senate race. I mean, we're starting to see, if you believe the polls, we're starting to see Arizona kind of slip away, both on the Senate. Mark Kelly taking, I think it's been coming up at 50% or maybe even over 50% against Martha McSally in some of those races. So that may not quite be, that's trending in that direction, but North Carolina is right up dead even for both the presidential and the Senate race. So another interesting scenario we should throw out here is, do we have an uncertain result of who's controlling the United States Senate as well, and what that will mean?
I want to touch on a little bit on something you said, Stacy, on the referendum election that is being set up by the strategy of the Biden campaign. It's an interesting exercise where, I think it is a smart strategy and effective. It necessarily results in, as a strategic question, less focus on what you're actually going to do and more focus on the incumbent. That is the strategy. So it has this question of, and I think we've seen kind of both sides of like a, Biden as a moderate, but in policy circles, there's been certainly conversation on the progressive side of, look at how progressive his policies are and some of this stuff. It does have this quality of, by both virtue of maybe strategy and kind of just what's happening, is that it's not entirely clear to me what the policy priorities agenda of a potential Biden administration end up looking like at the end of the day. It reminds me a little bit of kind of, it's like the 2004 presidential campaign, where the campaign was all about prosecuting terrorism, about the future of the war in Iraq and the direction that was going to take. And then in 2005, the Bush administration did Social Security reform. And all of others are like, wait a minute, what's going on? I thought with the terrorism stuff. And it has a quality of kind of like if the Biden administration acts on it, necessarily a campaign that is based on a referendum has less of a mandate besides just not this. So what do you think the direction looks like for actual policy from a Biden administration? What should the markets be expecting, especially from the economic policy side?
Now I'm starting to sound like a broken record, because I think one way to look at that is to know who has control of the United States Senate. And I think if Democrats control the Senate under a Biden administration, I think what you will be seeing is a very small window, 12 to 14 months, where you're able to take legislative action. And I think that will determine the pace in which, certainly economic recovery will be priority one for whoever wins. But I do think that the levers that will require congressional action, of which there are many to have a functioning government, will hinge on whether or not who's in control of the Senate. And so while a lot of the conversation has been about, how progressive is Biden, and is the AOC and Bernie pulling Biden to the left, and is he going to govern that way? The reality is you have to govern with or he has to govern within the realities of the legislative chambers that exist. And that will be as much of an impact on what is possible and what that agenda will look like as Biden's ideology will be. So I think really important to be watching the makeup of Congress and how that will affect. The other thing I will say is that, if you look historically at Democrats and economic recovery, and you look back to 2008 and 2009, some of what would be considered the most progressive policies that Democrats have brought forward and the largest spends on issues came in 2009. I mean, I think the most money Congress ever appropriated for clean energy came in 2009 in the Recovery Act. So in some ways, I think it's a mistake to talk about economic recovery and a Biden agenda. I think what we're going to see from a Biden administration is a lot of the policies and the things that they're pushing coming through economic recovery.
I think that's a really important point. People want to, okay, you do this, this, and this, and it doesn't have to be that way. You can kind of do a little bit of all three. I mean, not healthcare, but you can put a lot into an economic recovery bill.
Absolutely. And on healthcare, I do think it's a fair point, and everybody should be watching that a big priority, and this may be or it may come after, but a big priority of Democrats under a Biden administration will be to shore up the Affordable Care Act again. I mean, I think we saw threats from it in this administration, and I think that I don't think you're going to see a quick shift to Medicare for all, for example.
Yeah, that's an important point. I think that's it's not only a fear, but there's a narrative that, we're going, if they're going to tackle healthcare, it's going to be Medicare for all.
Yeah, and look, Republicans have all the incentive in the world to be pushing that narrative right now, because they want Joe Biden to be tied to socialist policies and AOC and Bernie and the left. I think the reality of that in a Democratic Congress and under a Biden administration will be shoring up what exists.
Would they have the votes for Medicare for all?
I mean, let's see what the breakdown of the Congress is, but I think
not. Yeah.
And I think we may have a different conversation absent COVID and the need for an economic recovery.
It's important.
That is where we are, and so I don't think we're going to be having a conversation about Medicare for all in January.
Yeah, it's interesting. So Stacy, you talked a little bit about like kind of the 14 to 18 month window. It feels. I agree with that kind of sentiment. That feels like that sentiment is held across Democratic circles. There's almost like here comes our window, and we gotta do what we gotta do, and a little bit of I don't know if a repeat expectations of a repeat of 2010 or something like that. It coupled that with, at least on the left side, a real and it seems to be mainstreaming a real appetite to get rid of the filibuster in the Senate. Should the markets be expecting a scenario of more political volatility over the coming decade? If the filibuster weren't in place, the ACA would be gone now. So it's interesting to think about. There's a trade-off happening of kind of like, well, we need to get rid of the filibuster to get the things passed that we want to get passed, but then necessarily those things become somewhat less permanent.
Yeah.
Or at least have to kind of, there's a lower threshold if those things go away. How should markets be thinking about that dynamic?
Well, I'd say another piece of that is the filibuster in the Senate, but also you have this little sneaky creep up of increased Democratic majorities in the House. So more of a chance of divided government for a longer period of time, which is an interesting dynamic to consider in that as well. I mean, I think if you look at back to the Senate, if you look at the Senate races that are up in 22, which is why which is what leads me to believe that there's this very small legislative window, the Senate will be equally, if not more competitive in 22. So I do think a prolonged, to your question, Matt, I do think a prolonged period of uncertainty and divided government is more likely than not.
If we do get rid of the filibuster, I'm announcing right now my candidacy for Senate from the great state of District of Columbia.
I mean, one of this election is upending all kinds of norms, obviously, and from the market perspective, typically the old saw on Wall Street is the markets love deadlock. In the current circumstances, with the economy obviously needing some stimulus here and the pandemic raging on, still lingering, and hopefully not going to get worse from here, but we'll see. But these are issues that really call for a government action, and so the bias toward deadlock that usually you see in Wall Street is maybe less strong this time, I think, because more investors are looking for the government to do some proactive and positive things for the public health space and the government space. And also there's it's no secret that Wall Street tends to be preferential, and markets in general tend to be preferential of the GOP, at least in concept. The light touch regulation and low taxes and so forth. But President Trump's a very different kind of Republican, and his, certainly when you have to accept a great degree of policy uncertainty and policy volatility, and particularly vis-a-vis, the U.S.-China relationship, which some analysts, worry that if he's in a second term, relatively less constrained, he's willing to take more chances on those fronts than he did than he might have in his first term, and so forth. So there's, the Republican bias that Wall Street tends to have is maybe a little less strong in this case as well. So I think that our sense is that a clear result, the markets will kind of learn to like either result, whether it's a Trump second term and still probably a divided Congress, or a Biden win, and as long as the result is valid and not contested in in a long, laborious and upending process.
So, all right, plenty of questions to keep us busy in the coming months. Let's take a quick break, and we'll be back in just a moment.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the HPS Macrocast. What are we looking at for the week to come?
So IHS Markit produces a monthly PMIs, both manufacturing and services. So we get those throughout the course of next week. It runs from Asia to US to Europe. So that's always enlightening. We also get some housing data and durable good orders. The housing data has been very strong. We had some data yesterday that was a little weaker, but it seemed to be affected by the hurricanes in the south.
It'll be super interesting on housing data to see over the next year how much of that is pull forward activity versus, an actual material change or something.
No,
like
I totally agree, because the low rates is obviously always stimulative. So you have that, but then you have this dynamic of people leaving the city.
Yeah,
but it's not exactly clear whether you're really leaving or you're just buying a house to ride out COVID and then you're going to go back to the city.
we lived in New York when we had our first kid, and we moved in Manhattan, and we moved out when we were pregnant with our second. And the playgroups that we were a part of, this was not a new phenomenon. It happens regularly, but I could very much picture in the current scenario where it's like if you're like reaching that point, all of a sudden you're making decisions.
Yeah, I mean, you have this dynamic where like the population of Bozeman, Montana has doubled in the last 3 months. Like that's not sustainable.
Yeah,
it's kind of fascinating, but housing has been a very strong driver of the economy throughout this crisis, and there's no particular reason to expect that to taper off in the next few months. And then we also, China's central bank, they have their loan prime rate, which is similar to our, Fed funds rate. The Chinese economy has actually really bounced back quite well, and they're kind of back to normal. Everyone's in school and the office and nightclubs. So they're very unlikely to cut anymore. And then we get some gauges of European, both business and consumer sentiment.
Great. All right. I think that's a wrap. Thanks, everybody, for listening to the HPS Macrocast. I'm Matt McDonald with Hamilton Place Strategies. Thanks to my partner, Stacy Kerr, John Fagan, and Brendan Walsh of Markets Policy Partners. Have a great weekend. We will see you next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.